Good afternoon, everyone. I cover Fintech for Reuters. I'm just going to start by asking the panelists to briefly introduce themselves.
Good afternoon. Monica Brand Engel, founding co-partner of Quona Capital, venture firm dedicated to Fintech for inclusion.
Hi, Shivani, Siroya, the CEO and founder of Tala. We're a mobile technology and data science company that has developed an Android app that allows us to instantly credit score someone using just the data on their smartphones. In addition to that, we actually do our own lending based on the credit scores. We currently work in Kenya, Tanzania, and the Philippines.
Matthew Saal, working in digital financial services within the Financial Institutions Group at the IFC, which is the private sector investment arm of the World Bank Group.
So we've heard a bit of what's going on in growth markets, but what are some of the most successful sort of leapfrogs that you think have happened, or just fintech initiatives that have happened in the growth markets you look at over the past few years?
So we're a thesis-driven fund, and a lot of our investment strategy comes from our experience doing retail financial services in emerging markets. So our sponsor is a microfinance organization. Our LPs are private institutional investors. And the opportunity they see is ones that have been articulated in previous panels. Even this morning when we heard Sequoia and Nubank talk about the white space, it's it's huge. And we see it being filled in two ways. One is, I would say, replicating models that have been successful in Western markets, like we did an MPOS investment in South Africa that's basically looking to expand the acceptance environment for digital payments to take advantage. When you heard that last panelist talk about M-Pesa, it's great to have a digital payment system, but if you have nowhere to use it, it creates a gap. So they're trying to solve that gap by equipping small businesses with digital. So that would be more of sort of I would say, an improvement on an existing model. The leapfrog happens with things like Tala, and we have an investment, again, on the SME finance in Mexico called Confio. And Confio is basically using similar digital footprints of SMEs, of small and medium enterprises, to lend to them. And there's a trend in Latin America which is called facturización, or digitization of invoices. And what that means is the government is requiring small businesses to actually produce digital receipts. And the reason they're doing that is to stop tax evasion, stop the under-the-table activity. But what happens immediately is that you have a digital record of cash inflows and outflows. So it allows lenders to basically see immediately what the working capital needs of these businesses are. So rather than lend against the value of an asset, a piece of an equipment, or lend against the personal collateral an entrepreneur might have, you're actually lending exactly what the business needs. And to me, it's, again, so it's a multiple trend in that I think in many markets, they're digitizing informal sectors even faster than we are in Western markets, and bringing people, businesses, and consumers who are invisible into the mainstream.
So do you have any other sort of obviously you can tell us a bit more about what your business does and how that can be considered successful.
Sure. I mean, I think when I think of what really the core of our business is more about financial identity. And so while we are interested, obviously, in access to credit and other financial services, we actually think of it as how can we first develop a relationship with these customers and to really understand their daily lives using the data on a smartphone. Because at the end of the day, that is what they have access to. And so I think where we're seeing the leapfrogging, or where we see kind of the potential for these markets, is actually thinking beyond a bank branch and actually thinking of it more as let's just meet the customer where they are and actually develop tools that are more customized to them. And I think that's what we all have the ability to finally do, which is actually more interesting than I think we've been able to see in the previous years. So I think that's the first piece. And then I think the other thing that I'm really excited about in the industry is products or companies that are working on the system change. So, I mean, obviously all of us are talking about blockchain, but I think it's whether can we recreate bureaus, can we recreate how we score, how can we understand, and then how can we help other companies in the space actually use data more effectively.
So how much does the success of an application or of a product depend on its location? For example, we heard about M-Pesa. How successful has that been in moving on to other African countries?
Well, we've seen mobile payments take hold in some markets and not so well in others, and usually the difference is regulation. And in terms of innovations, to your previous question, payments and probably identity are the foundational two pieces. There's lots of things that are built upon those. But if we want to go back to sort of basics and core infrastructure for what all of us are doing in digital, it really depends on good payments infrastructure. And the mobile networks provide that. The extent to which they've been allowed to provide that with or without banks, the extent to which banks have been ready to partner has varied across country. And part of that is the market microstructure of the banking system in particular markets and the way the regulators approach things. But we've seen the success in Kenya. We've seen huge success we were an early investor in bKash in Bangladesh. So it's not specific to any one market, but it has varied widely across markets.
Mm-hmm. And what about what are the most active players you see now? For example, here we've heard a lot from startups, but are you seeing, for example, telcos stepping in, or the banks playing a big role? Who do you think will sort of win these markets?
I'll take it. I'll take a first stab. I mean, Quona, the name of our fund, means something in every language where we work, and we chose that name because we believe in connection. You'll never hear us say banks are dinosaurs, even though that would be a popular thing to say here, because we don't think they're going to just disappear. We think they will have a role in this new world order. I'll give you a concrete example. Half of our portfolio companies are balance sheet businesses. They either lend to SMEs or lend to consumers. And the reality is it is incredibly difficult to mobilize capital at the rate of growth of our portfolio companies. So banks are good partners, if we can get them to lend in a sort of cost-effective way. There is a reason why deposit mobilization is regulated. Whether or not that broadens beyond it, we do think there's a role for some of these institutions to play to be fiduciaries. But we think, again, the mobile network operators I think are complicated because they're very good at acquiring consumers, but they're not very interested in anything more than selling airtime. What we've seen is that all those mobile wallets, you saw the 277 million. Let's ask the speaker how many of them are active. Most of them are empty. And that's the problem, because the mobile network operators haven't figured out how do you develop a compelling value proposition to get someone to use it for more than just paying for airtime. So I think, we think there's going to be a combination. Who's going to win? I think it's going to depend on the country, depending on the regulatory environment. Some markets make it a lot easier for MNOs to win, like they did in Kenya. In other markets will be banks because they're protected or because they have incumbency or loyalty. But we take an ecosystem approach and really try to help our tech startups work with the ecosystem.
And go ahead.
We get to straddle. We've got a network of probably 800 financial institution relationships globally in emerging markets, probably the largest network of such relationships anywhere. And we also invest in fintechs. So we look at innovation across both sides of that divide, if it is a divide, but we actually see it converging. More and more banks are moving forward in their digital transformation, and that often means partnering with fintechs. The interesting thing about financial innovation is it's removed the information and contracting barriers that define Coase's theorem and in terms of what had to happen inside the unitary firm. And I could pull out my iPhone and say that it's been made in 10 countries and 10 different producers, and I'll pull out my credit card and it's coming from one bank. Well, increasingly, banks are able to subdivide the value chain and use different technologies and different providers if the regulators will allow them. So we see a huge potential for innovation and partnering with fintechs who are providing point solutions, new products, new services, or new ways of doing things to leverage the assets that the bank have against the technology that the new providers are bringing.
So have you seen the banks and the more established players have more of an interest in some of these markets that they've traditionally kind of not served because they weren't very profitable? Because they often speak about financial inclusion and the rest, but do they actually see it as a business opportunity now or not yet?
I think they do. I'll give an example. So we have a company in Brazil called Creditas, and Creditas is basically provides asset financing to low and emerging consumers in Brazil. And what they're taking advantage of, back to the country specifics, there are a lot of, the middle class is growing in Brazil. It's a good story in terms of poverty alleviation. And what that means, there are a lot of people who might own an apartment, own a vehicle, so they have equity, and the idea of home equity loan doesn't exist. That category doesn't exist. So Creditas came around, sees these enormous interest margins that banks are earning, and said, we can help unlock credit by allowing people to refinance expensive consumer debt, unsecured consumer debt, and take out an asset-based loan, whether it's a home equity loan or a car loan, and actually, and even lending against actually, like we've seen in other emerging markets, using the asset not just to finance that asset, but actually other services like a home equity loan does. So they actually initially decided to work with banks. They digitized the end-to-end process from customer acquisition to payment, and they were working very positively. But then the crisis hit. Banco Itaú, which is one of their biggest bank customers, pulled back and they said, it's too risky for us. We don't want to, and again, part of it was regulatory driven in terms of the kind of capital adequacy ratios. So Creditas, our portfolio company, now has its own fideicomiso where it can raise money and lend against its own balance sheet, but also will work with banks. So there is an example of banks, when they have the appetite and all the enabling environment is right, they'll do it. But they're very fickle and will pull back when it's, something goes wrong.
World Bank Group has made a commitment for universal financial access by 2020. That means bringing another billion people into formal financial services. That means lending to people who are newbies, who don't necessarily have familiarity with what an APR is or the context of an amortization schedule. And we're also reaching them through mobile channels, which means there's no face-to-face interaction in some cases. So it's extremely important that we look at this from the perspective of how the banks that have existing relationships and channels can reach them more efficiently and more effectively. And the technology allows them to reach those high-volume, low-value consumers with products that are efficient and effective. Met with a bank in Zambia last year. They've got a small consumer loan process, but it's a 5-page application. You can't do a $50 loan profitably and handle that by hand. So they're looking at the technology and looking at which fintechs to partner with in order to deliver that. But Shivani can probably speak to, to how some of that high volume, low value works.
Yeah, I mean, I do think that some of the infrastructure work that we're all talking about, so in Kenya, for instance, we do both positive and negative reporting to the Credit Reference Bureau. And so without us even partnering with a bank, there is now a pathway for a customer to go ahead and go out on their own and actually advocate and say, hey, I have a credit score, I have a credit history, and they can walk right into a KCB or an equity bank. So some might actually say, well, you're giving your customer up, but I actually think what it does is create a more sticky relationship. And so it makes it so what we all need to do is be more intentional, I think, about the relationship that we want to develop with our customers, and what are the products that we want to actually own and offer, as opposed to what a bank or the ecosystem already provides. And so in some ways, I think it allows a startup to focus on what they're actually good at, as opposed to trying to just replicate everything.
And have we normally seen the most successful startups and products be homegrown? Or is it maybe startups coming from developed markets or products originated in developed markets that are transplanted to the growth markets that have success? Do you need to have a homegrown element? Or does it not matter?
I always think you need a homegrown element. So, the example I gave before was MPOS, and you have the Squares and iZettles of the world. And we have 2 portfolio companies, one through our venture sister fund called Venture Lab. It's called CLIP in Mexico, that just got investments from General Atlantic. But when we started, they were a small sort of mobile point of sale. And that model was started in Western markets, but it really got refined and adapted because the interest rate margins and even the SME customer acquisition costs are very different. So I do think you have to, we call it tropicalize it locally. There are some models, though, that are really unique to the emerging markets. We talked during the break, Coins PH, which is it's our portfolio company in the Philippines, and basically what it's doing is it's integrating all the core uses the informal sector uses digital for. So mobile top-up, bill pay, and remittances, usually peer-to-peer. And they basically, and unfortunately, most informal sector do those at different distribution places. So they go one place to pay their bills, they have to wait on another line to get a cash remittance, and go yet a third place to top up their phone. So even basic financial functions is very inefficient. And so what they're doing is integrating those payments, and again, in a way that is very different. I don't think you'll see a model like Coins in the West, but basically integrating these informal distribution in an effort to move this customer to digital. So they're making it easier so that all of these transactions ultimately can happen digitally, but they're meeting customers where they're at, as Shivani said, and offering a cash out. Like you can imagine, would you keep a debit card in your wallet if there were no ATMs? Probably not. And then slowly that's what the transition they're trying to engender.
I think another interesting model that may, in its, let's say, third iteration, make it over to this side is what we see now as the PayAsYouGo Solar, which really started as people developing this home solar lamp with a place to plug in a cell phone, and then realizing that not enough of people in East Africa, say, had the capital up front to buy it, so offered it on a floor credit micro leasing model, the PayAsYouGo Solar, with some technology that's part of one of Monica's portfolio companies to help with the monitoring. And that created a structure in which not only do you have sort of a micro-leasing portfolio that's going up around this pay-as-you-go solar panels, but you're collecting data about the customers, you know their behavior, and at the end of the payback period for that asset, you now have an asset that can be recollateralized for another loan. So you basically have turned kind of an Internet of Things micro-leasing collateral business. And I think that model is the level at which it'll come back into this market, where you could have a television that gets sold on installment with an automatic payment and a turn-off mechanism.
Actually, PayJoy is, I saw that on the, I don't know who was speaking about it, that is what PayJoy does. PayJoy lends to you for cell phones, and now they're exploring, can we use that credit experience to actually lend against other things? So it is already coming back.
Well, but it's already happening with some of the big PayAsYouGo Solar are recollateralizing the assets for just a standard consumer loan. For school fees or whatever. So we've already seen the development from the PayAsYouGo Solar company to now a micro-leasing company.
Oh, I meant in the US though. PayJoy is in the US.
Yeah.
Yeah.
But I do actually think that that aspect of going from solar to TVs to things does require localization, because you do need to know what the next advanced product would actually be. And so I think you've got to find ways that you can have centralized kind of data analytics, data science or credit. But then when it comes to product development, it's going to vary between Kenya, the Philippines are two totally different markets. I mean, as an example, just what we saw with the coins experience versus M-Pesa in Kenya, our customer experience in Kenya from downloading to actually getting money in your wallet takes us under 5 minutes. So it's an instant product in Kenya. In the Philippines, we expected the same kind of experience for our customers, and that was what we were shooting for. But now customers can get it within hours, and for them that is actually instant, because otherwise they're waiting on lines, and that's what they're used to. So we actually had to learn that from our local team and doing the user research, that even making that process slightly better is actually like above and beyond what's in the market right now.
So how long does it kind of take you to move to a new market, and how much work, sort of, how many people do you need on the ground? And
I think it depends, again, by country. So if we're in Tanzania now, it's a much more similar market to Kenya. You have similar mobile rails. You have the same companies also working there. You have a similar dialect and language. So you're going to be able to service a lot more out of Nairobi, as opposed to going to let's say a new country entirely like Mexico or the Philippines, which is so different than Kenya. I think it's a good challenge for a company to do that in the early days, because you have to develop your processes and models so that they are globally applicable. But I think that's really where user research and localization and understanding the customer's daily life is incredibly important.
so what are some of the biggest mistakes or most common mistakes that you see startups making, or that maybe you made at the beginning?
I'll start. I think the number one, and Shivani just said it, is assuming the consumer behaves similarly. So I was listening to the Nubank presentation, and they said millennials are similar across countries, and I think that's probably true. And there are a lot of similarities we see in the informal sector across markets, but there's a lot more, there's a lot of distinct, both in how the product is packaged, the delivery mechanism, regulatory compliance, and so I think underestimating the time, because there's always a push to scale when you have venture investing, and I think realizing that doing it right will save you. A taxi driver said sometimes you have to go slow to go fast, and that's an emerging market truism that you have to really get it right in order to really go up the J curve.
I'll speak not so much to a mistake, but a challenge. I mentioned before that we're talking about banking a whole lot of people who haven't been banked before, and doing that responsibly and in a way that doesn't result in over-indebtedness or misuse of credit or perhaps incorrectly damaging people's credit records when it was a product that they didn't fully understand or was pushed to them over their phone. Not suggesting that anybody on this stage is doing anything like that, because I think the responsible standards, and Shivani's been part of sort of ahead of the crowd, I think, in many ways on that. But that question of how do we protect the consumer even before the consumer protection infrastructure is in place becomes a very important one in these markets, and a challenge, and those who don't get ahead of that challenge will make mistakes.
So how many of these products have been able to get transposed in developed markets? Have there been any success stories there? Or do you think that will be a big thing going forward?
So we just made an investment about 4 months ago in an insurtech company in South Africa. It's called All Life. And basically they have a very disruptive model where they insure people who insurance companies typically filter out. So they insure people with HIV/AIDS and with diabetes. And the way they do that is by aligning incentives. They actually partner with clinics. And the only condition, in addition to paying your premium to getting the insurance, is agreeing to get on a certain medical, and in the case of diabetes, diet regime. And they corroborate adherence by biannual or quarterly blood tests to make sure that you are taking what you're supposed to. And once you do, what happens on the actuarial side is that you tap into all this medical research that can tell you that, yes, even someone with, everyone is going to die, but once you start taking the medicine, you have a much greater predictability of when that might happen. So you can offer them a 10, 15-year life insurance, and knowing that they will lose some customers, but you're actually betting on them staying alive, which is what the customer wants. So there's a Royal of London, which is a UK insurer, loves the model, and in Western markets, we have very high penetration rates, which is different than emerging markets where you have low insurance adoption. So they're just trying to get to new segments. So they've actually imported All Life into the UK and are actually launching a pilot to target people with diabetes in the UK.
Are we likely, do you think, to see some fintech giants emerge from emerging markets and then take over the rest of the world?
Well, if we count China, yes, already.
Exactly. Alibaba.
I think that there's an opportunity to really build brands in these markets. So again, I keep going back to the relationship piece, but I do think it's an important one, because even though you have large traditional banks, even like the Barclays of the world in places like Africa, you haven't seen them really, I would say, go deep into markets and develop that brand with the majority of the population. And so I think the opportunity that fintechs have and startups is you're almost starting from the person up, right? And so you have this ability to develop a very deep personal connection that can then translate into a wide range of other products.
Mm-hmm. And why do you think some of these products seem to have faster adoption in growth markets rather than here? For example, I might be wrong, but M-Pesa is one of the most successful mobile money applications worldwide.
I mean, 2 reasons. One, you saw the numbers about the unbanked. I mean, the quality of service and infrastructure is just completely absent. And there's whole sectors that have just been overlooked. So I'll give you an example. We have a company in India called Neo Growth, and they do merchant cash advance, which is kind of a seedy business in the US. And basically what you're doing is you're taking merchants that might accept digital. And so what they have a problem is that it takes 30 days for the credit card company to settle that transaction. So in that 30 days, how do they restock their shelves? So merchant cash advance is lending against that credit card receivable. And in the US, it's become kind of an exploitative business of taking advantage of SME lack of access to finance. What our company in India did, they actually chose to be regulated. It's a repeat entrepreneur. He understood very well, he was in the fintech world doing software as a service banking, understood his margins really well, and actually went with a merchant cash advance product. So the product's not very different. It's just that he went to the regulator, chose to be invited to regulation in, which meant interest rate caps, which India has, but it also was a barrier to entry. So now anyone who doesn't want that scrutiny is not coming in as competitors. He's grown 14x in 1 year, in about 15 months. And that's again because there's no one, it's a real need, so anyone any merchant accepting a credit card has this problem, and they have to borrow from the money lender or an uncle, and he provides a seamless service. So they're lining up at his door.
And I think it's localization again. I mean, when we look at the way that M-Pesa became successful in the beginning, it was by targeting chamas and microfinance institutions to help with the repayments and the remittances. And then they started these kind of brand campaigns around, I think it was very geared at sending money home to your mother. Right? And so they tied into that cultural ethos of this is something that we all do and we're responsible for doing. Or if you look at what I think is happening in India, they're also tying it into this thing of the government does subsidy programs, but they haven't been able to actually create a very accurate system for that. So that was where the need came from. And so I think that it provides that incentive that then ties into why your customer is going to come to you. But I also still think that when you think of access to credit kind of programs as well, at the end of the day, we know that there is demand for that, but we shouldn't take advantage of that. We should really think about what's best for the customer. So is it a means to an end? What are we trying to do with the credit product too?
So are there some lessons that I guess you've learned that you might share with companies here from developed markets, or from developing markets to developed markets? Matthew?
Well, I think the challenges are somewhat different, and one of the reasons we've seen adoption of say M-Pesa because there wasn't an alternative, and there were many people who didn't have a bank branch nearby, didn't have banking services. So there are segments in the U.S. There's a huge underbanked segment who might benefit from that in these markets. But if you want to generalize more, it would be to not be afraid of going after those opportunities in the segments that don't look quite as well. The fact that they weren't well served might be the opportunity rather than that they've been screened out for real reasons.
Mm-hmm. And Shivani, what were some of the lessons you learned actually on the ground? What are some of the things you wish you knew before you started?
I guess there's a lot, but I think segmentation is a big one. So I think of it as I could go to one of our countries, but I think actually India is a really good example of this, which is there's about 700 million people that really even the new startups that are in the market aren't probably targeting, but a company like us shouldn't actually just go into India and assume, okay, this is, we're going to scale immediately in this market. And really what we need to do, and the lessons I think that we learned, are we probably need to go to one particular city, one particular segment, even within that city, one particular age group, and build products for that, prove that that can be successful, and then from there really start to open up your funnel and go to new segments. But I think that would be the difference between developed and developing markets, is that because the population as a whole is underserved, I think they still have very customized needs. And so I think from a product perspective, we shouldn't come in and assume we can build for a mass market right away.
Mm-hmm. And I guess last question, because we're running out of time. Have you seen we spoke about the incumbents or the established players there already. Have you seen them willing to partner? You work with the credit bureaus, right? So have you seen, and maybe you guys can share experiences from other geographies, but if you're a startup coming from another country, is it likely that you'll be able to get through the door and establish something with them?
I think there's huge interest on the part of the incumbents. It's topic number one. Everybody understands that digitization is reshaping the banking and financial services industry. I think the biggest challenge is in terms of internal culture. And we spend some time on our advisory practice side working with financial institutions on organizing for innovation and understanding not just the technical needs, but also what they need to do internally to begin to take advantage of what's available, whether that's in data analytics across their existing customer base and processes and products, or whether it's in terms of how to hook up their systems to an external product or service provider or a new channel. So really changing established cultures is a real challenge. less an issue right now of interest and willingness, but actual ability to execute.
Monica, do you have?
Similarly, I would say, that, and it was part of our lesson learned, is that these markets are really dynamic. So even when you think you have it right and you're actually getting traction, you'll have an external shock or you'll have a major player make a move or change in strategy. And so the agility and speed at which you need to shift and pivot is really important, and that's not in a bank's DNA. So banks move very slowly, they make decisions really slowly, so our biggest challenge is on operationalizing it. I think there is desire or fear from the top that will get people engaged, but operationalizing it, not only from the beginning, but ongoing, is our biggest challenge.
And recognizing that one of the reasons that banks move slowly is that their regulators are sitting on their shoulders and saying, what's that? We've had a number of, there are many countries which don't have regulations in place to permit cloud-based services, for example. So it's a challenge for the banks. There's reason for it that goes beyond just their internal, but that needs to change as well.
Okay, all right. I think we finished on the right second. So thank you very much.
Thank you.